Alright, back for a market update for my little channel, The Market Pace. I've always kind of prided myself in not bullshitting, so I want to get straight into it, but getting straight into the disclosure. This is not investment advice, this is just what I'm doing in the markets, my opinion of what I'm seeing, why I'm doing it, when I'm doing it. Yeah, so not investment advice. Do your own due diligence, do your own research. If you have no idea what you're doing in the markets, and I do encourage you to go seek out a financial advisor, get a nice foundation for where you're at financially right now, where you need to be at in the future, a way to get there, and then start learning and researching and try to improve your results to get there faster. You can possibly do that with watching my videos, but that's not really what they're for. This is more to document what I'm doing and as I'm doing it and how I'm doing it. So now that's out of the way, let's get into the video. So for the update in a quick synopsis, my current stance is non-leveraged, so we're out of the SPXL leverage position. At the end of that trade, that whole thing made about 3%. Since then, that was a few days ago, the S&P 500 went up another 2 to 3% on its own in a non-leveraged position. And year to date, that's leaving me at about 25% to kind of cap my results at so far. I'm going to go into the charts, show you that in the chart wise and where I made those moves, and then I want to show you something a little interesting about some beef. Cool, so we're in the charts now. So just to remind, I guess everyone out there, this is where I had started the position on, it was about April 1st. S&P 500 hit an all-time high. The Dow Jones Transports was also at an all-time high. To pull that up, boom. And it did pretty good. I mean, the transports went straight up for about a month. The S&P 500 went up for about a month. And then the market kind of hit some turbulence. Investors got a little bit worried about inflation data that was coming out. And I've said on these videos a few times, inflation's kind of a good thing for your asset prices. It does lead them to rise up higher. However, it does signal to the Fed that they need to raise interest rates, which will signal to the investors the party's over. So that's what kind of scares investors when they start seeing these high inflation numbers. What happened around these few days was the CPI number, which is Consumer Price Index, which measures a lot of consumer goods like toilet paper, shampoo, even cars to some degree, just a bunch of products. And their prices rose on an average of 4.6%, which is a measure for inflation being at roughly 4.6%. Now, the Fed likes to have inflation at about 2%. They have said multiple times now they're okay with it running higher than that, but still 4.6% is a lot higher than that. So that was scaring a few investors that the Federal Reserve may start to either taper back how much bond purchasing they're doing, or taper back how low interest rates are, so they'll raise interest rates. And that's scary. Scared a lot of people out of the market. Stocks dropped about I think it was almost 4% roughly. And that actually signaled to me to get out from what I've said in previous videos. So what I did say in previous videos was that if the S&P 500 drops 5% from its all-time high, which was on this date, the all-time high being 423.80, which you can kind of see in this number over here when pointing out for that date, 423.80, to 5% of that. Now that didn't happen on the S&P 500, but I did also say if the Dow Jones Transports drops from its all-time high by about 5%, closes under 5%, then that signals that we should get out of this trade, and you might see some turbulence, and it's not worth the added risk of having that leverage. So when it was at an all-time high on this date, the May 10th, again, this number over here, that number being 16,170.05, it did drop under that by a few points on May 12th, so that signaled to me, get out of the leverage position. At that point in time, I got in here, so I got out here, made a small gain. It was about 3%. Since then, once I'm out of the leverage position, I go into a non-leverage position, like the S&P 500, being done by just investing into the SPY. And since then, it went up 1.2% the next day, and right now, as I'm filming it, another 1.68% the day after. So just a tad under 3%. And all in all, it's leading me from when I was first leveraged at the start of the year. I made about 26% of that trade. The next time I was leveraged, I lost 6%, bringing me about 20. And now I've made 3% on this new leverage position, bringing me to 23. And now another 2 to 3% on the non-leveraged position. So roughly 25% for year to date. Since we're not even halfway through the year, I'm enjoying it. I think it's pretty good. But that's where everything is at as far as my investments are going. I'm just highly into SPY, just full into SPY, and a couple of my initial public offering stocks, a little bit of Coinbase. I did get rid of the little bit of Bitcoin I had. I had maybe like a, I don't know, 10% of my account or something in Bitcoin, not necessarily huge, but actually it's more like 5%. Anyway, I got rid of that and went into ADA, the symbol, that being Cardano. That's done pretty well since then. That was about a week ago, and it's up 20%, so can't complain there. That's my little bit of crypto exposure, that and Coinbase. Still have some mushroom stocks by Mind Medicine and Compass Pathways, and several other IPOs. You really got to follow my Instagram stories to kind of stay up with those. I don't really do videos on it because there's not that much there. But again, I'll link up here somewhere the video for how I choose those IPOs, which I tell you is probably the most valuable thing I've ever put out on YouTube, next to paying attention to all of this stuff, because you can make a good amount of money with a little portion of your portfolio with the initial public offerings, but this you can make a fair amount of money with your whole portfolio of your whole position, the whole position being the whole portfolio, or at least a large amount of the portfolio. So when you really hit it well following this type of strategy, you hit it big time because it's a lot of money that's in it. With initial public offerings, you hit it well. It's still just a small amount that does well. Both of those have their pros and cons, though, of course. So there's that. Next thing I want to show you is the beef I have with the markets going on. So for that, I'm going to go into TD Ameritrade. I don't think TradingView actually has very good futures charts, so let me switch screens. Excellent. So we have TD Ameritrade's Thinkorswim platform pulled up here, and these are the feeder cattle futures, which you can look up by typing in /GF. In particular, this is the September contracts, which is one contract ahead of where we're at right now. Right now, the August contracts are the primarily ones trading, but you can still buy the September ones, which is going to be the ones I'm going to primarily talk about in this video. I do want to have to point out, though, the feeder cattle futures are the cattle that'll make it to your table as a steak or ground beef, whatever, what have you. And I find it funny that the symbol for that is GF, which, you could say stands for gluten-free, which, if you're familiar with any sort of food, steak is most definitely gluten-free, so I find that funny. Anyway, so more to something that actually matters. What is recently happening with a lot of restaurateurs is their steak prices and chicken prices and seafood prices, for that matter, have all rose pretty quickly. This primarily is because of an increase in labor costs, which is happening just about everywhere in every industry, but it's very apparent with restaurants. So they now need to charge more money for chicken, more money for seafood, more money for steak. And when I was hearing about this in roughly early May, so around here, I wanted to look at the futures and commodity prices. So they don't really have any commodity markets for seafood or chicken. Major reason for this is because if you have an imbalance in supply and demand with seafood, you can just kind of go fishing more. If you have an imbalance of supply and demand with chicken, you can raise more chickens, and both of those will even out the supply and demand imbalance within a month or two. Because chickens only take 2 months or so to raise before you can bring them to the slaughterhouse and bring them to your table. And fish, you just gotta fish more. It takes a few days, a few weeks to catch a lot of fish, whatever. Now with feeder cattle, the cows to make your steaks, that takes roughly 2 years to equal out an imbalance. And if you're actually following the lumber markets, which have really skyrocketed, lumber takes like 10 years sometimes to even out an imbalance, because trees take a while to grow after all. They used to try to make chicken futures markets several times, but they never took off because of this fact. It only takes 2 months or so to fix an imbalance in that supply and demand, so you don't need to buy contracts that are several months to a year out to hedge your rise in costs as those commodities become low supply, high demand. With feeder cattle, you're seeing the same thing happening. Actually, you saw the opposite of what you'd expect. So labor markets were rising in price, making the steaks more expensive. When I looked at the feeder cattle futures, I saw that despite steaks being some of the highest costing items that they've been in a long time, the actual cattle market was actually oversold, and beef in a way was actually cheap. It's just the labor costs were adding so much money to it, which is kind of scary for a restaurant that's now worried that this beef is going to get too expensive for them to keep buying, or they're going to have to raise their prices for the consumer, for their customers, just to a point where they're not even going to buy it. So essentially, if beef was cheap and it's actually selling at its highest prices ever, there's a lot more room for it to get even worse for them. And Tyson Foods, in their last quarterly earnings report, had said this as well, that there's a reduction in live cattle processed, partially associated with severe winter weather. And also they have a challenging labor environment, so not as many people to process all of the cattle. Yet their sales volumes were flat, and even they're expecting more strong domestic and export demand going forward. So demand is staying the same to increasing, but the supply is lower because there's not as many cattle there. Oh, and they even mentioned here a facility they had a fire last year, which is causing them to have less production as well. So all of that is keeping supply low while demand is staying the same to increasing, or at least that's what they're expecting. So that will translate to this oversold condition going on in the market, as determined by this RSI statistical analysis. This just crunches a bunch of numbers to give you a technical analysis way of saying this is really high or really low. So yeah, since this was really low, we have some room to run up, and since then it has most definitely run up. From roughly 145, 146 to 152, almost 153. This is 4 to 5%. Now that might not sound like a lot, but before I say this, I want to say I'm not necessarily that versed in the futures markets and commodities. It's not the primary thing I trade or spend that much time looking into. However, I know a few things. So one of those things is you can have roughly 33 times leverage in just Ameritrade. Other brokers, you can have up to 50 in America. In Europe, you can have up to 100 times leverage. So for $1,000, you can hedge $33,000 worth of beef purchases. So at this 5% gain, if you put in $1,000 into this market, you'd actually have roughly 150% gain on that 1,000, so roughly $1,500, which you can then use that profit to, you can just sell that contract and you have $1,500 to counter the rise in costs to your beef that's been happening. So that's just a hedging 101 lesson, which I do pretty often in my videos. It's a cornerstone of my investment strategy for the S&P 500. Just like in COVID, when the COVID crisis started in late February, early March, I had hedged my accounts with the SPXU ETF, which gives you 3 times the return of the opposite what the S&P 500 does. So if the S&P 500 drops 1%, this SPXU ETF will go up 3%. So what I would do is hedge most of my long position that was non-leveraged in the S&P 500 with about 25% of that amount in the SPXU, and overall my portfolio wouldn't move at all. So during the COVID crisis, markets would open up down 10% and then open up 10%, and my account during those days would move less than 1%. There was very little movement for insane amounts of volatility. In fact, the highest volatility that I think the stock market's ever seen, when you talk about the VIX anyway, the VIX fear volatility gauge. So I got to sleep very peacefully during that time when others were wondering what the heck's going to happen tomorrow. Now a lot of restaurateurs are in that same boat. They're wondering what's going to happen to my beef prices tomorrow. Or are they going to stay the same? I don't know. They could be using these futures markets to hedge their costs on the beef by just putting in roughly 1/30 of what they would expect to buy from now until September. And that would hedge any sort of ups. If the beef prices were to continue to rise, they would hedge any increase to their costs of buying more beef. Now, if they were to decline, they at least have the demand of the summer months to get them to that they could keep their prices high as it already is. And with that high demand, consumers would likely pay that to, at least keep the cost that they're paying right now where it's at. And also, as prices were to fall, if they were to fall, they're going to get cheaper prices on their beef. So they, make the money back there just by paying less on their actual raw goods. It is a bit unfortunate that there is no chickens market or seafood market for these commodities. But there is also sort of a way you can hedge those too. It's a bit of a derivative. It's definitely not as one-to-one. But you can do I believe it's soy. No, that's not it. Sorry. The soy futures. Fuck. So there is a way to hedge chicken as well. It's not as one-to-one as with beef, but you can hedge it with using the soybean futures here or the corn futures. We got soybean here, and we have corn, and oats as well. Corn. Now basically all of these are already pretty high, or at least they were. They're starting to come down a little bit. But since cornmeal and soy meal and oatmeal are the things they use to feed chickens as they raise them, if there's more chickens growing, they're going to need to buy more of these soy. They're going to need to buy more corn, and this will raise the demand for corn and soy, and that typically raises the cost of chickens. So that will, in a way, hedge any further rises in chicken. It's definitely want to do a little more math if you were to go that route to hedge chicken costs. It's nowhere near as one-to-one. And I would only say this is worth doing if you were buying an absolute ton of chicken. McDonald's actually is known to kind of do this every now and then because, they've got thousands of restaurants to sell thousands or tens of thousands of chicken nuggets. They go through a lot of chicken. So to keep their prices mostly maintained and mostly flat, they often buy a lot of corn and soybean futures and commodities to keep those costs, relatively stable. This way they don't have to fluctuate their menu prices that often. But they're a huge, huge consumer of chickens. Most individual restaurants or even restaurant chains aren't as big as producers as McDonald's or consumers as McDonald's of chicken. But I just wanted to mention that. I wanted to mention that there is a way to hedge your actual costs of goods as a restaurateur and a lot of other industries. But do take everything I just said with a huge grain of salt because I'm not all that versed in futures markets and commodity markets. It's not something I trade often. It is, if you were to go down this route, is something I would highly recommend talking to a commodities broker about, getting in touch with some of the professionals in TD Ameritrade or some other broker to make sure you have the intricate details of what you're getting into, correct. Because I'm making several assumptions because I have not ever had to trade one of these, especially not in a way that was for a real life scenario to hedge, raw goods, as a restaurateur might be thinking about doing right now. However, just, again, wanted to mention it. That's the beef I have with the markets at the moment, and a really cool real-life application of hedging for business. Because that's the only hedging I often talk about is just as far as it goes for investments, for your personal accounts. Yeah, so that'll about do it. That's all I got. As always, everyone, stay safe out there. Happy trading. And the market pace is now closed.